Hello, this is Tom Allender of Wall Street Branding. This is the first in a series of many company resource videos that we will be publishing. Okay, the title on this one is Why the DTC Ineligibility and Subsequent Trading Restrictions Are Killing Companies, Their Liquidity and Their Ability to Raise Money in the Marketplace. Well, first of all, as everybody probably realizes, the DTC is a monopoly and it provides the electronic clearing for all U.S.-based companies in the stock markets. And unfortunately, because the DTC is a monopoly, what they say goes. And now many companies that are on the DTC ineligible list are growing. Now, a lot of people think, well, you do a reverse split, you get DTC ineligible. The problem is that a lot of companies are doing a reverse split and then they're immediately doing a funding. And it's in the way that they fund themselves that the DTC does not like. 504s. The DTC is determined that this form of funding is illegal and will not electronically, which means quickly, clear the stock of the companies that end up on their ineligible list. DTC ineligible companies have to be cleared with paper certs on a weekly basis. It's costly and time consuming. The clearing firm, which in a lot of cases for micro and small companies as well as the big companies, is Pinson. And they're passing on these excess costs of doing paper certs and the time involved to make these certs and everything else. That's subsequently being passed on to trading firms. And the trading firms are passing these costs on to customers. Now, when the customers, after they've been trading a stock for a month or two, then they get their statement in from their online trading firm, and see fees anywhere from $200 to $500 for trading these stocks. These people are not happy. They close their position, they get out, and they do not get back in again. So now, instead of dealing with the headache of paper certs and associated costs and pissed off customers, online trading firms are not allowing trades on DTC ineligible stocks. That's not to say that they're not allowing trades on all DTC ineligible stocks, but if your stock is trading volume, then that means that's going to be more paperwork, more accounting that has to be done, more costs, and that you will get shut down at the electronic trading firms. And in some cases, these online trading firms will allow customers to call in orders. Well, so what? What difference does that make? So you have the guy call the order in. Well, I'm going to tell you why this doesn't work either. Now, a person that's going to invest in your company is more than happy to call an order in. I mean, after all, they're going to buy the stock and they're going to hold on to it for some period of time. But I'm going to tell you something, and the reason why I can tell you this is because I was a trader myself. And traders will never, ever, ever call in orders to any broker. It takes too much time to execute the order. The market's moving too quickly to get orders executed. They are never going to call the order in. And the reason for this is because traders rely on quick entrances and quick exits from a position. And they want to be able to see that on their level 2 screen and have everything lined up there right in front of them so that they can place their orders quickly with just a few mouse clicks and get out of the stock in the same way. Just a couple of mouse clicks and they're out. Traders, this is very, very important. Traders want the ability to route their orders to different market makers, ECNs, and what have you, to fill their orders. They're not going to call up some full-service broker and put in an order and just have it blindly routed into the market. The order is not going to get filled, and that's all that there is to it. Now, using online brokers, all the big popular ones, $7.95 per trade, these traders can trade these stocks all day long, and they can route them to the market makers of their choice. They can route multiple orders to multiple market makers. So the brokers like E-Trade, Ameritrade, Scottrade, MyTrack, AB Watley, Speed Trader, they allow the traders to route their order. And again, it's 6 to 8 or more market makers. This is very important to a trader. So if your stock is on restriction at these firms, traders will not buy your stock. They're not going to phone the order in, and they're not going to put in a blind order. And it's also important to realize that 90% of your actual liquidity in the marketplace comes from these traders that are using these online firms. In summary, again, if I haven't beaten you over the head with the hammer with this, here it is again. Traders will not use a phone to trade under any circumstances. I never would do it. Any trader, anybody that knows half of what they're doing is not going to use a telephone to make trades. And you're going to lose 90% of your liquidity if major online firms put you on restriction. So they may be able to trade your stock if you do light to moderate volume. But if something happens and your stock really starts to trade in the marketplace, the costs are going to go through the roof, and they're, rather than putting up with all the customers bitching at them and so forth and so on and all this excess time and cost, they're just going to put you on restriction. Solution. As of right now, there is no solution. However, if you have a company that has revenues as in fact a real company, we may have a solution for you. It may or may not be a solution. It's going to have to be taken on a case-by-case basis. Contact us if you want more information. Again, this is Tom Allender. Thank you very much. Send me an email if you have any questions.